Hi, I'm Professor Suneel Maheshwari at Department of Accounting with Indiana University of Pennsylvania. Today we'll be talking about plant assets and various depreciation methods used for depreciation of the long-term assets. In the balance sheet, you look in the plant assets, you'll find land, building, machinery, furniture and fixtures, and land improvement. And the related account which we'll open is depreciation account, expense account, and accumulated depreciation account. Now, as far as what do we depreciate? We depreciate the cost of the plant assets, which basically, now the next question is, what is the cost? Cost of any asset is the sum of all the costs incurred to bring the asset to its intended use. So if you are doing some testing for the machinery, then before you bring it to the commercial use, it is part of the cost of bringing it for its intended use. So purchase price is there, or taxes that you have paid, or commissions that have been paid to buy the asset, and that other amounts that are necessary to make the asset ready for use are all part of the cost of the asset. Anything which is capitalized or which is a capital expenditure becomes part of the cost of the asset, and that gets added to the cost and is not expensed immediately. For example, any extraordinary repairs, major engine overhaul, modification of body for new use of truck, etc. Those are all capital expenditure, and they are not expensed like repairs of transmission or other mechanisms. What is depreciation? This is the process of allocating a part of the cost of the plant asset as an expense, and it is done over the life of that asset. So we take a part, or we reduce the part of the cost from the income statement as an expense for a particular year, and then for the over the life of the asset. Depreciation expense will be reported in the income statement as an expense for that period, not part of the asset is getting used up in year 2016, then we need to match it to the revenues of 2016. First method, there are three methods of depreciation which are commonly used. One is the straight line method. Second is the units of production method. Third is the double declining balance method. Now, if you look at the cost of the truck and subtract the estimated residual value of 1,000, the depreciable cost of the asset, in this case a truck, is $40,000. Let's assume the estimated useful life is 5 years or 100,000 miles. If we use the straight line method, we depreciate equal amount each year. And depreciable cost, which is 40,000, is divided by the useful life in number of years. So you have 40,000, which is the cost, depreciable cost, minus your residual value of 1,000 will give divided by the 5 years useful life. So 40,000 divided by 5 gives you $8,000 of depreciation expense for the year. This expense, which represents the use of the asset for that 1 year, is charged to the income statement. The journal entry to record the depreciation is, since it's an expense, it is going up and it is debited. Then we create another account called accumulated depreciation account. So the depreciation which is charged over a period of time gets accumulated in this account, and it is shown as a reduction from the cost of the asset to show the book value of an asset. So for example, if the asset was purchased on January 1, 2011, and for 41,000, its residual value was 1,000, and depreciable cost is 40,000. The book value on January 1 is 41,000. At the end of the year, on 12/31/2011, $8,000 of depreciation is charged, and your accumulated depreciation account increases by $8,000. Accumulated depreciation account is a permanent account, and it is not closed every year, and it is closed only when the asset is sold. From the book value of 41,000, you subtract the $88,000 to come to the balance of 33,000. And then next year also, you've got an 8,000 reduction bringing down the value to 25,000, and the accumulated depreciation account to 16,000, because you've got 2 years of depreciation expense, depreciation inbuilt now over there, accumulated over there. So as the accumulated depreciation account increases, the book value will decrease. Finally, the asset's final book value will be equal to the residual value, in this case $1,000. Let's take an example. Suppose FedEx has a sorting machine that costs $10,000 with a useful life of 5 years and a residual value of 2,000 purchased on January 1. What is a straight line depreciation? Your cost is 10,000, your residual value is 2,000, so the cost that you have to depreciate over 5 years is $8,000. You divide it by the useful life, and you've got the depreciation expense of $1,600 for the year. Second method of depreciation is units of production method. Now, in this case, depreciable cost is divided by the useful life in terms of units of production to determine the fixed amount per unit. And then this per unit depreciation is multiplied by the number of units produced or number of units used during each period to compute the total expenses for the period. Let's take the example. We have a depreciable cost of 40,000 for the truck, and we said the useful life of that truck could be 100,000 miles. So after 100,000 miles, we are estimating that the residual value of that truck will be $1,000. And we divided it by 100,000 miles. So the per mile cost of our depreciation is 40 cents per mile. Now, depending upon the usage over the period, so let's assume the units used in the first year are 20,000. Rate per unit is 40 cents. So the depreciation is $8,000 in year one. Similarly, if you use 30,000 units in year two, your depreciation is 30,000 times 40 cents, giving you 12,000. Please note the accumulated depreciation increases every year as the asset is depreciated. So in the first year, the balance in the accumulated depreciation account, which is a contra asset account, is 8,000, and the accumulated depreciation in the second year is 20,000. At the end of the 100,000 miles, its book value is $1,000. So the cost minus the accumulated depreciation gives you the book value. So in year first, your book value is 41,000 minus 8,000, 33,000. Then in the second year, it is 41,000 minus 20,000, which is 21,000, and so on. To record the depreciation expense at the end of 2011, the entry remains similar to what we did earlier. Entry doesn't change. Your depreciation expense is debited by 8,000, and your accumulated depreciation for the truck is credited by $8,000. The last method which we are going to discuss is the double declining balance method. When you use the double declining balance method, why is it called double declining is because whatever the straight line rate is, so in this case the straight line rate was 20% because 1 divided by 5, which is the life of the asset, is 20%, so you double that to 40%. When you use the double declining balance method, you write off the larger amount of assets cost near the start of the useful life of the asset. And how do you compute it? Very simple. You've got 1 divided by the useful life in years, which was 5, gives you 20%, and you double it. That is, multiply it by 2. So 20% times 2 gives you 40%. So the remaining process will more or less remain same, but you are charging 40% on the book value of the asset. So it started with 41,000, 20% of 41,000 will give you 16,400, less 41,000 less 16,400 of accumulated depreciation will give you 24,600. Next year you charge 40% of 24,600, which will give you 99,840, and your accumulated depreciation account increases by that balance. Then in the next year again, you take the book value of the at the end of the previous year, multiply it by 40%, and once you do that, you can get the book value. So once again, in this case, you took the 40% of the book value to come to 16,400. That's why, since it is being charged on the declining book value and it is double the normal rate, it is called the double declining balance method. So you need to remember to charge this on the declining balance or declining book value over the period of time. In this case, we ignore the residual value of the asset except during the last year. Now if you look at the last year, that's the time when we charged the depreciation out of 5,314. In the last year we charged 4,314, and we have a residual value of $1,000 remaining. That was the uh, final year depreciation. Becomes kind of a plug-in figure while maintaining the residual value. So the double declining balance method differs from other methods in two ways. First year depreciation is based on the full cost of the asset, not on the depreciable cost, as in the other two methods. Second, final year depreciation is a plug-in amount which is needed to reduce the book value to its residual value, as we saw earlier. So here is an example. You've got $10,000 FedEx sorting machines with a residual value of $2,000. Now instead of straight line, if you use the double declining balance method, the 40% depreciation in the first year based on the total value is $4,000, and your book value is $6,000. Then 40% of the $6,000 will give you the depreciation expense of $2,400, giving you the annual depreciation of $4,000 plus $2,400 at $6,400. And your book value now has gone down to $3,600, which is $10,000 minus $6,400. And so on. Third year, you got 20% of $3,600, and in the last year, you got nothing left. It was down to $2,000, so no depreciation was charged, and your book value is $2,000. So if you compare these three depreciation methods, generally speaking, if the plant is generating revenue evenly over a period of time, then you use the straight line method. And units of production method is good for the assets that wear out over a period of time because of its use. And in the double declining balance method, if the asset generates higher revenue in the earlier period, then you match the higher expense of depreciation for that period. So if you put all these three methods together, your straight line is obviously straight over the period, straight or same amount of depreciation over the period, and it comes to 40,000. Units of production is based upon the usage, but over the 5 years, it'll come to 40,000. In the accelerated method or double declining balance method, one of the accelerated method, it is in the first 2 years, most of the depreciation has been charged. About 26,000 has been charged in first 2 years, and then the remaining over next 3 years for a total depreciable cost of $40,000. If you look at the graphical representation, this is how the graphs would look like for the three methods. Now, as far as this is a sample of depreciation methods used by about 600 companies, and you'll notice the most common one is straight line depreciation, followed by the accelerated method of depreciation or double declining balance method of depreciation. And the units of production is the third most popular method.